In the last video, we talked about the reset. Silver had gone through a sharp flush, gold had held its structure, and the market had just come out of a very volatile phase. At that point, things were still unfolding. So instead of reacting to every move, we took a step back. Over the last couple of weeks, prices have moved, stabilized, and in some cases, started building again. And now that we have had that time, we can come back and look at it with a bit more clarity. Because what we are seeing now, it's not just recovery. It's how different parts of the market are positioning after the reset. Let's start with silver. After that sharp move down, what matters is not the drop itself. It's what happened next. Price didn't keep falling, it stabilized and started rebuilding. At the same time, Shanghai has been trading at a premium to COMEX for weeks. So even while price corrected, physical demand stayed firm. That tells you something very specific. The move didn't fail. The excess around it got cleared. And when that happens, the next phase becomes much more interesting. Now let's zoom out. SPX is pushing higher, gold is holding strong, silver is catching up, copper is stable. Bitcoin is starting to turn again. Everything looks strong, but if you slow down and look closer, the reason behind that strength is not the same. And that's where the real signal is. Some assets are moving because conditions are supporting them. Others are moving because they are being accumulated. Take equities. SPX is strong, but underneath, liquidity is still elevated. So far, the overnight funding rate is still high. Bonds are not conforming the move either. So the strength is there, but it still depends on conditions holding. Now compare that with real assets. Gold held through the correction, silver reset and recovered quickly. Copper didn't break structure. These are not just supported moves. These are moves where buyers show up consistently, and that is called structural strength. Now look at the dollar. We've had geopolitical tension, uncertainty, and yet the dollar isn't rallying. That's not typical. It suggests the dollar is no longer acting as a clear anchor. Now oil? Oil dropped sharply this week, but the reason matters. Strait of Hormuz is reopening. Ceasefire is reduced risk premium. Strategic reserves being released. So oil is reacting to events. It's not driving the broader structure right now. So if we step back and take a look at our earlier video on the monetary regime change, we talked about 2020 being the ignition and 2025-2026 being the early phase of acceleration, where real assets begin to take the lead. Not in a straight line, but through resets, volatility, and repositioning. If you look at what's happening now, real assets are holding strength, financial assets are participating but still supported. The dollar is losing clarity and volatility is compressing again after spikes. This is not random. It aligns perfectly with that roadmap. So instead of focusing on short-term moves, look at where the consistency is. Right now, the most consistent strength is coming from real assets. Gold, silver, copper. That's where the trend is forming. And when leadership starts to shift, the structure of the entire market begins to shift with it. So if this transition continues, then we are not just looking at a short-term move. We are looking at the early stages of something bigger. Because regime changes don't happen in weeks, they unfold over years. And if that's the case, then the real question is, are we still reacting to price or are we preparing for a new kind of market? A market where real assets play a much bigger role, a market where volatility eventually compresses, not today, but over time. A market that starts to look very different from the last decade. If you found this video helpful, don't forget to like, share, and subscribe. You're watching MarketVelugu Light on Markets. See you in another interesting episode.